funds go into the trust, right? From there, the note payments will start being received after we agree on an investment allocation model, and you say, yes, this all looks good, let's get it invested. You'll start receiving note payments right away. And then you'll have regular reviews with your advisor and the trustee to see how things are going, right? So that's the DST process in general. And if anybody has any questions, feel free to get my contact information from Carrick. Maybe Carrick can send out some information afterwards, and I have some brochures on both strategies that I can share with everybody as well, right? And here is the other side of the coin, of the DST coin here, which is the Delaware Statutory Trust, right? So again, it makes it very confusing with the same acronym here, but now this is a completely different strategy we're talking about. We're talking about 1031 exchanges and Delaware statutory trusts, right? So a Delaware statutory trust is just a business entity that goes out there and purchases a piece of real property in the name of a Delaware statutory trust. And it's a syndication that's usually created by a company like Cantor Fitzgerald, Inland, JLL, Ares, very, very large commercial real estate investment groups, typically. And they'll usually purchase institutional quality real estate assets. Could be a $100 million industrial building, a manufacturing building. It could be a $150 million Amazon logistics facility, whatever it is, or a multifamily property, anything. There's all different types of asset classes that can be owned inside of a Delaware statutory trust. And we were speaking about TICs a little bit earlier. It is a little bit similar to a TIC in the way that it's fractionally owned by multiple investors, but there are some major differences. First of all, some of the problems I've heard with TICs in the past from clients who have done them is, hey, if I've got 5 individuals that pool our money together and go buy a single tenant, triple net lease property, and everything is going very well, when we go to sell it, or we have an offer from somebody who wants to buy it, one person could potentially hold up the whole transaction, and it can kind of be a nightmare to get everybody to agree on everything or get on the same page. The other thing you potentially have is everybody has to qualify for debt that's inside of the TIC, and there could be capital calls in the future if all of a sudden roof needs to be repaired. Everybody has to put in money to fix the roof, right? With a Delaware statutory trust, you don't have any of that. All of the voting rights, all of the decisions on what happens with the property is determined by what we call a DST sponsor. And those are the groups like Cantor Fitzgerald, Inland, NextPoint, JLL, Ares, Hines, et cetera. Those are the groups that syndicate these offerings and manage those properties. So you give up some control, like you mentioned, but in turn, you don't have to worry about dealing with any headaches or property management or tenants, nothing, right? So it is a very streamlined and efficient way to complete a 1031 exchange. But generally speaking, a DST is fractional ownership in institutional quality real estate, and you can have up to 499 individual investors invested in one single DST, right? And within the DST wrapper, it could be one property or it could be multiple properties. A couple dozen properties inside of one single DST. It just depends. To give you kind of a quick background, there's probably 80 or 90 different individual DSTs available in the market today. Multifamily, self-storage, industrial, build for rent communities, senior housing. And another one I really like is mineral rights. There's mineral rights in oil and gas in the Permian Basin in Texas that we work with. I think it's one of my favorite investments right now. So a lot of different asset classes. Do you have a question here?
Well, that's something that my CPA said about
1031 exchanges.
Mm-hmm.
They don't have to go to another property. I want to now find out if that's the same thing. When she said they could go to a REIT, they could go to an oil and gas investment. Is that fundamentally a DST that she's talking about?
I would imagine so. Yes. I'll speak on that a little bit. So Eric asked if it could go when selling your property, you can invest in other real estate like a REIT potentially, or oil and gas mineral rights. The answer is yes and no to that. So there are DSTs that own all of those different asset classes, but you can't exchange directly into a REIT. REITs don't qualify for 1031 exchanges. However, like you alluded to, there are DSTs that you can exchange into the DST first, and then after a 2-year holding period, if it's Hines, for example, and you've exchanged into a multifamily apartment complex that's a $80 million huge, or 2 apartment complexes inside of it. Within 2 years, Hines will come in and say, hey, we're going to purchase the properties or property inside of that DST that you exchanged into and bring it into our large multi-billion-dollar REIT. In doing that, it's called a 721 up REIT or a 721 exchange. There's no tax liability for doing it. But what you've done essentially is exchange your interest in that one single DST for now shares in a large multi-billion-dollar REIT with hundreds of properties in it. The benefits of doing it is greater diversification, right? You now own shares of this large $4 or $5 billion REIT. You still continue to receive monthly distributions. The downside, and I think it's a pretty big downside, just depends on who you are and what you're looking to accomplish. You can no longer 1031 exchange out of that, right? Because you're now in a REIT. So it is now your last stop, unless you redeem your shares and cash out, at which point you will pay long-term capital gains taxes when you cash out.
But, yeah, if you're just planning to live out your life on
Yep.
your inheritors, get a stepped up basis.
You still get the stepped up cost basis in it.
To get the last stop.
Yes.
Pass that on, and they could then decide to sell it with a stepped up basis.
Yep.
Or continue to own the asset as it.
100%. 100%. Here's my 2 cents on it is if you are 65 years old and you're selling a property and doing a 1031 exchange into a DST that has the 721 UPREIT structure like that, you have a lot of life to live left. And you're going to be stuck in that REIT maybe for 20 plus years unless you take the money and cash out. There are other DSTs that will sell. The average hold time in a standard DST is 5 to 7 years. If you want the flexibility to be able to pivot and maybe go back into direct real estate, exchange into another DST, going into a DST that doesn't do the 721 UPREIT could be a better fit. I think the 721 UPREIT structure is very beneficial for somebody who is 80 plus years old and they say, look, I don't want to do another 1031 exchange. I'm fine leaving it in there, getting some income, and then passing on to my beneficiaries. I think it's much better fit for that individual, right? Yes, sir.
Well, it's also a great fit, you're a regional local developer and you build a portfolio of 5 or 10 properties.
Yeah.
And you decide that you don't want to, you want to kind of cash out, so you go to equity residential. And you do the UPREIT and they take it over, and now you got publicly traded stock that you can do what you want with it.
Yeah. I mean, from there, like you said, it provides, the benefit it provides is access to liquidity if you ever want it or need it, right? And it still defers all the taxes. You receive some income, but generally speaking, it is going to be, your last stop. And if it is a publicly traded REIT, then you are going to be at the mercy of the market fluctuations and volatility, of course.
And that's what happened to what's come in years ago. They traded into equity residential.
Mm-hmm.
And you would have to tell you right.
Yeah, most of the REITs out there are non-traded REITs, so it's private REITs. So the prices don't fluctuate all the time like you would see in public REITs. But those are most of the ones that I'm familiar with out there in the markets, like with all the large groups out there that are currently offering them. So I'll try to get through this and wrap it up. I don't know how are we on time? Okay, good, perfect. I always feel how much time we got. So the advantages of the Delaware Statutory Trust. The biggest one, in my opinion, well, not the biggest one, there's a lot of them actually, but the turnkey replacement property solution. I've got clients that I got a gentleman I'm working with right now. He's selling a property in Long Beach for about 2.1 million. He has $500,000 of debt on the property. I worked with him last year on a different property. He came back again, a repeat client, said, let's do this again. He's closing on April 2nd. I've been in communication with him for the last 2 months before closing, after he basically had an offer on it, saying, hey, okay, let's start looking around. We've been working with each other to develop a Delaware Statutory Trust portfolio. right? So we've already come up with it. It's ready to go. The day he closes, we can start paperwork and he can be done and closed in the DST portfolio in about a week, give or take. I mean, way before his 45-day identification period is up. So all done with the exchange in about a week, give or take, completely done. So very turnkey replacement property solution, depending on when you start looking at your replacement options.
Why is that different than just doing a 1031 into those properties that are identified and just having done the pre-work to know what they're gonna be?
Well, the big difference is this individual wants passive ownership. And I mean, the timeline could be the same for sure, but this individual wants hands off. He travels a lot. He's in other countries a lot. He has owned real estate for a number of years, done very well, but he's like, you know what? I want to sell. I don't want to have any more management or deal with property managers, whatever it may be. Let's get into something like the Delaware Statutory Trust. It'll pay me income steady and taxes are deferred. He can pass it on to his kids when he passes, you know, et cetera.
Would he work with you on properties that are investment vehicles?
Correct. So the Delaware Statutory Trust isn't an identification. Out of the, like I mentioned earlier, there's probably 80 or 90 different options that you have out there. So you work with me to whittle it down to say the top 5 that you want to look at, right? And based on our experience and knowledge of the industry, because the DST industry is very fragmented, there's a lot of different sponsors, we call them. There's about 45 to 50 sponsors out there, like the Inlands and Cantor Fitzgerald, JLL, yada, yada, Aries. So based on our experience and knowledge, we give recommendations for our clients to what we think are going to be the best investments for them that not only hopefully get some appreciation on the property sales, but our number one goal is to protect and preserve our clients' wealth, not get into something that's super risky or aggressive, and then also provide stable monthly income, right? So our clients, most of them, they don't want to take on a lot of risk. They don't want to go and try to find a value add opportunity or a development opportunity, or, you know, they want to just something that's steady Eddie. They've already gotten quote unquote rich. They want to stay rich, right? They don't want to have big risk. Yeah. So turnkey replacement property solution, it provides them with access to institutional quality real estate. So you sell a property for $1 million. Most individuals aren't going to go buy a property for $50 million, right? So they can own that property, a fraction of it, by investing into a DST. Maybe it's more stable, whatever it may be, whatever the reason is, gives them access to institutional quality real estate investments. Also, I'll speak to that, this other thing on diversification real quick, but passive management and passive income potential. I'll give you a couple quick examples. Vast majority of my clients are retired or retirement age. They've owned real estate 30 plus years. They're just tired of dealing with it. They just want to sell it, get it something passive, go on to, it's cheesy, but we call getting out of the toilets, tenants, and trash and going to the cruises, clubs, and cocktail part of their life, right? I mean, it's cheesy, but that's a little term in the industry. So most of them, that's what they're looking to do. This is what this accomplishes. There's also a low minimum investment. Most DSTs have a minimum investment of about $100,000. So if you sell a property for $1 million, you could theoretically diversify into 10 different properties, 10 different DSTs, diversified by asset class, location, et cetera. I usually recommend 2, 3, 4 different DSTs on $1 million exchange, but it's up to the client. They can do it however they want.
But the fees are different than the other.
Completely different. Yes. And I will cover that for sure. Diversification, again, I mentioned that already. Non-recourse debt is huge. So the gentleman that I spoke with, he's selling a property for 2.1, has 500,000 of debt on that property. If you do a traditional exchange, normal exchange, you go qualify for new debt, replace equal or greater amounts of debt as well. With the DST, you can replace all of the debt, but you don't have to qualify for the debt. It's all considered non-recourse. You're not personally liable for it. Doesn't go on your credit report. It's there to meet your exchange requirement needs, but it's not, you're not attached to it. The sponsor has already qualified for the debt, and they just allocate